Stock market took a significant dip today, fueled by a sell-off in tech stocks. Let's pull it up. As you can see, the Dow Jones fell about 0.75%. The S&P and NASDAQ also closed the day in the red, down around 1.5% respectively. And CBS News contributor Javier David joins us now, also the new business editor at the Dallas Morning News. Javier, we appreciate your time. So what was driving that decline in the market today? I mean, we saw tech stocks like Apple, Amazon, Nvidia all dipping a bit.
Yeah, not a banner day, and certainly sort of a soft last several sessions or whatever. But I want to sort of throw this statistic out at you. As of Thursday's close, Dow up roughly 17% this year. S&P gained 28%. The NASDAQ has climbed over 34%. So, like, basically this entire year has been a Santa Claus rally of sorts. We've seen a lot of strength in tech stocks. In the absence of a fresh catalyst, markets have this way of just selling off because they don't know what's coming. It's about rebalancing. Yields are actually quite high, and I think that's got a lot of people nervous.
You mentioned the Santa Claus rally. I think some people still want to know, with a couple of days left in the year, can we see one of those potentially?
Well, not out of the question, but there's softness and there's a little toing and froing. But I wouldn't get a whole, based on the statistics that I've just given, I wouldn't get overly upset. I think that actually, and just to sort of clarify, Santa Claus's rally is the last 5 trading sessions of the year and the first 2 of the next year. So January has the potential to set us up for a really good year. And a lot of analysts are already saying that that's quite already a possibility.
We do have a new report from MasterCard finding that holiday sales rose nearly 4% from last year. So which sectors are benefiting the most, and does the willingness to spend, that's the big thing, indicate consumer confidence in the economy?
Yeah, look, 'tis the season, as they say, and all the things that you'd expect to be selling well around this time of the year are. So clothing is doing quite well. Clothing actually is one of the fewer areas in the market or in the economy that isn't seeing a lot of inflationary pressure. So lots of deals to be had, lots of discounts, et cetera, et cetera. My favorite fact, consumer spending, nearly 70% of the economy. So how consumers feel in terms of their confidence and they're willing to open their wallets and keep charging those credit cards up is a very big deal for the economy. Folks are spending more on clothing, as I said. Data showing a lot of restaurant activity, a lot of splurging in, eating and going out and so forth. Blingy things, diamonds are a girl's best friend, but sometimes they're a guy's best friend too. So jewelry's doing quite well in this environment, and online spending is also just a big channel. So people are just spending online as they usually do this time of the year.
I can't let you go without asking a question. Many at home are constantly checking in on, constantly wondering, what is the outlook for interest rate changes in the upcoming year?
So, yeah, look, sum it up, the Fed did a really curious thing and kept rates too high for too long, went out of its way to prime the markets for a sustained rate cut campaign, and then all of a sudden the data started coming in, and inflation really seems to be sticking around in a way that is making a number of the policymakers a little uncomfortable. You have a new administration coming in. A lot of what they are proposing is sort of stimulative, and that is just putting things, it's scrambling the outlook. So now you have the market sort of gaming for the fact that there's an over 90% probability the Fed will just keep rates unchanged in February and maybe just will stay where we are for a while. And that's something that markets weren't necessarily prepared for several months ago.
It is a delicate line. You know better than anyone they are trying to walk right now. Javier David with some great insight for you. Javier, thank you as always for your time.